Welcome back to Britain Benefits Alert. Today we're covering something every UK pensioner absolutely must understand. The Department for Work and Pensions has officially confirmed that December 8th marks a pivotal moment for state pension payments across the country. This is confirmed information directly from the DWP, and what arrives in your bank account after this date will look noticeably different from what you've been receiving throughout the year. The DWP has now released the finalized details regarding the upcoming changes, including who will be affected, the exact payment amounts, and the complete schedule for payments from December 8th onwards. These are not projections or estimates. These are locked-in figures that will directly impact your weekly income, your monthly budget planning, and your financial outlook for at least the next 12 months. So what exactly is changing on December 8th? There are several significant developments happening simultaneously. First, we have the new state pension rates under the triple lock increase, and this year's rise is larger than many analysts had predicted. Second, there are adjustments to how certain components of state pension are calculated, particularly affecting those with incomplete national insurance records. Third, some pensioners will experience changes to their payment dates due to system updates at the DWP. And critically, there are correction payments being issued for groups of pensioners who have been historically underpaid, resulting in backdated lump sum payments arriving alongside regular December payments. And let me be absolutely clear about what December 8th represents. This date is when these changes go live in the DWP payment systems. This means if your regular pension payment date falls on or after December 8th, you will receive the new increased amount. However, if your payment date falls before December 8th in early December, you will receive one final payment at the current rate, and then your subsequent payment will reflect the new higher rate. Now I want to address the confusion that's understandably spreading among pensioners nationwide. The DWP announcement about December 8th encompasses several different types of changes occurring at once, and frankly, the department has not done an adequate job of explaining which changes apply to which pensioners. Some individuals will see their payments increase by the standard percentage uplift. Others will see additional increases because they fall into correction categories where historical errors are being addressed. Some pensioners will find their payment dates shifting by a day or two due to the system changes, and a small number of people might actually see decreases if they were previously being overpaid and those overpayments are now being corrected. The absence of clear, personalized communication from the DWP means millions of pensioners are left attempting to decipher generic announcements to understand whether these changes benefit them, harm them, or require them to take action. That situation is not acceptable, but it is the reality we face. That is precisely why I am breaking down every confirmed aspect of the December 8th changes for you today. Let me explain exactly what December 8th signifies within the DWP payment system and why this particular date carries such importance. There has been considerable confusion about whether this is when payments arrive or when changes take effect, and understanding this distinction is absolutely essential. December 8th is not necessarily the day your money lands in your bank account. It is the date when the new state pension rates and calculation methods become active in the DWP computer systems. What this means in practical terms is that any state pension payment processed on or after December 8th will use the new rates and the new calculation methods. For the majority of UK pensioners, state pension is paid every 4 weeks, and your specific payment day is determined by the last 2 digits of your national insurance number. If you are paid on a Monday and your payment date happens to fall on December 8th or any day after, you will receive the new increased rate. If your payment date falls on December 1st, 2nd, 3rd, 4th, or 5th, you will receive one final payment at the current rate, and then your next payment 4 weeks later will be at the new rate. This is why December 8th is significant as a cutoff date rather than being a universal payment day for everyone. Now let me provide you with the actual figures that have been confirmed by the DWP, because this is the information you genuinely need to know. The full new state pension, which applies to people who reached state pension age on or after April 6, 2016, is increasing from £203.85 per week to £221.20 per week. That represents an increase of £17.35 per week. When calculated monthly, that works out to approximately £75.18 extra per month, or £901.20 per year. For a pensioner couple where both partners receive the full new state pension, that amounts to an additional £1,802.40 per year coming into your household. For those of you on the old state pension system, which applies if you reached state pension age before April 6, 2016, the basic state pension is increasing from £156.20 per week to £169.50 per week. That is an increase of £13.30 per week, which translates to approximately £57.63 per month, or £691.60 per year. Many people on the old system also receive additional state pension on top of the basic amount amount, and those additional components are also increasing by varying percentages depending on which specific element you receive. The reason behind these increases is the triple lock mechanism, which guarantees that state pension rises each year by whichever is highest among inflation, average earnings growth, or 2.5%. For this year's increase, it is the earnings growth figure that is driving the rise. Wages across the economy have grown by 8.5% over the relevant measurement period, and that is the basis for the state pension increase. This represents one of the more substantial percentage increases we have witnessed in recent years, which explains why the actual pound amounts are quite significant. Now let me address the changes to calculation methods that are also taking effect on December 8th. This is where matters become more complex and where some pensioners might experience different outcomes than others. The DWP has been reviewing how state pension is calculated for people with incomplete national insurance records, and they have identified inconsistencies in how gaps and partial years were being treated. The new calculation method going live on December 8th is intended to be more accurate and fairer. However, in practice, this means some people's pensions are being recalculated. For most pensioners who have been receiving state pension for years, this recalculation will not change anything. Your pension amount is locked in when you first claim it, and subsequent changes to calculation methods do not usually affect existing pensions. However, there are specific circumstances where recalculation does occur. If you have recently claimed state pension within the last year or two, and there were questions about your national insurance record, your pension might be recalculated under the new method. If you deferred claiming your state pension and are claiming it now, the new calculation method applies to you. And if you have had corrections made to your national insurance record recently, such as adding missing years or claiming missing credits, those corrections might trigger a recalculation under the new method. The impact of these recalculations varies considerably. Some people find their pension increases because the new method treats certain gaps or partial years more generously. Others might find their pension stays exactly the same because both methods produce identical results for their specific circumstances. And in rare cases, someone might find their pension decreases slightly if the old method was giving them credit for something the new method does not recognize. However, the DWP has stated they are applying protections to prevent anyone losing money due to calculation changes. Let me now address the payment date changes occurring for some pensioners. This is causing understandable anxiety for people who have had the same payment day for years and are suddenly being told it is changing. The DWP is updating its payment systems, and as part of this update, a small percentage of pensioners are having their payment days shifted. Most people are not affected by this, and your payment day stays the same as it has always been. But if you are one of the people whose payment day is changing, you should have received a letter from the DWP explaining this. The reason for these shifts is technical and relates to how the DWP distributes payment processing load across different days of the week. If too many people are concentrated on one payment day, it creates processing bottlenecks, so they are rebalancing the distribution. If your payment day is changing, the letter you receive will specify what your old payment day was and what your new payment day will be from December 8th onwards. The key action is to watch for that letter and make note of the change so you are not left worrying when money does not arrive on the day you expected it. Now let me discuss the correction payments for historical underpayments, because this is where some pensioners are going to see substantial lump sums arriving in December alongside their regular payments. The DWP has been running systematic correction exercises after discovering they underpaid certain groups of pensioners over many years. The main affected groups are married women whose pensions should have been uplifted based on their husband's national insurance contributions but were not, widows and widowers whose pensions should have increased when their spouse died but did not receive the increase, and people over 80 whose pensions should have automatically increased at age 80, but the increase was never applied. December represents another wave of these correction payments being processed. If the DWP has identified you as having been underpaid, recalculated what you should have been receiving, and determined that you are owed money, that payment is scheduled to go out in December. The amounts vary enormously depending on how long you were underpaid and by how much. Some people are receiving a few £100s covering a year or two of underpayment. Others are receiving tens of thousands of pounds covering 10 or 15 years of substantial underpayment. If you receive one of these correction payments, it will arrive as a separate transaction from your regular state pension payment. You should receive a letter from the DWP explaining what the payment is for, how it was calculated, and what period it covers. The letter should also explain whether any tax has been deducted from the payment and what your new ongoing pension rate will be going forward now that the error has been corrected. Here is the frustrating reality that must be addressed honestly. The DWP's identification of people who were underpaid is not complete. They are using computer algorithms to search through millions of pension records looking for patterns that indicate underpayment. Those algorithms are finding many cases, but they are not finding everyone. There are pensioners who were underpaid who have not been identified by the automated systems. Unless those people proactively contact the DWP and request their cases be reviewed, they will continue being underpaid and will never receive the correction payments they are owed. If you are a married woman who reached state pension age before April 2016, you should check whether you are receiving at least 60% of your husband's basic state pension. If you are receiving less than that, there might be an error. If you are a widow or widower and your state pension did not increase when your spouse died, that is a significant warning sign. If you are over 80 and you did not see your state pension increase when you turned 80, you have almost certainly been underpaid. In any of these situations, you need to call the pension service on 0800-7310469 and explain your circumstances. Request that they review whether you have been receiving the correct amount. Let me explain how these changes interact with other benefits you might be receiving, because state pension does not exist in isolation, and changes to your state pension can have knock-on effects. If you are claiming pension credit, your state pension increase will reduce your pension credit slightly because pension credit tops up your income to a guaranteed minimum. When your state pension goes up, you need less pension credit to reach that minimum. However, your total income still increases overall because the state pension rise is larger than the pension credit reduction. If you are receiving housing benefit, council tax reduction, or other means-tested benefits, those benefits are based on your income, and your state pension is counted as income. When your state pension increases, your means-tested benefits might decrease slightly. Again, you are not losing out overall as your total income goes up. It is just that the increase is shared between higher state pension and slightly lower means-tested benefits. If you are receiving non-means-tested benefits like attendance allowance or personal independence payment, those are completely unaffected by your state pension increase. One concern I am hearing frequently from pensioners involves tax and whether this state pension increase will push them into paying tax when they were not paying it before, or whether it will increase the tax they are already paying. State pension is taxable income, but no tax is deducted at source from your state pension payment. If your total income, including state pension, is below the personal allowance, which is £12,570 per year, you do not pay tax. If your total income is above that threshold, you owe tax on the amount above it. The state pension increase means your income for the tax year is rising by around £900 if you are on the full new state pension, or around £690 if you are on the basic old state pension. For some people who are currently just below the personal allowance, this increase will push them over it, which means they will start paying a small amount of tax. For people who are already above the personal allowance, the increase means you will pay somewhat more tax than you were paying before. HMRC collects this tax either by adjusting your tax code if you have other taxable income like a private pension where tax can be deducted, or by sending you a tax bill at the end of the year if your only income is state pension. Let me outline what you should actually do in response to these December 8th changes. Some people need to take action, while others simply need to be aware and verify their payments. If you are a typical pensioner who has been receiving state pension for years with no complications, you do not need to do anything. Your December payment will automatically be at the new increased rate if it is processed on or after December 8th. Simply check when the payment arrives that it is the correct amount based on the new rates I have provided. If you think you might be in one of the groups affected by historical underpayment, you need to contact the pension service and ask for your case to be reviewed. Do not assume that if you were underpaid, the DWP will automatically identify you and contact you. Many underpaid pensioners are not being identified by the automated systems, and you need to be proactive about checking your own situation. If you received a letter stating your payment day is changing, ensure you have noted the new payment day and adjusted your budgeting accordingly. Consider setting up text alerts or banking app notifications so you know when money arrives in your account. If your state pension amount has always seemed lower than you expected and you have never understood why, December is an excellent time to call the pension service and ask for a full explanation of how your pension was calculated. They can access your national insurance record and walk you through exactly which years count as qualifying years, what gaps you have, and how those translate into your pension amount. Understanding your pension properly means you can identify if there are errors or omissions that need correction. Looking at the broader context, the state pension age is still rising. It currently stands at 66, but is scheduled to increase to 67 and eventually 68, meaning people are waiting longer to receive their pensions. The triple lock mechanism, while beneficial in years like this when there is a substantial increase, remains politically controversial. And there are ongoing questions about whether it is sustainable long-term or whether future governments might modify or remove it. The administrative challenges at the DWP, evidenced by the historical underpayment errors being corrected now, demonstrate that the systems managing pensions are not as robust as they should be. Mistakes occur, payments are incorrect, and the burden falls on pensioners to verify their own entitlements and challenge errors rather than the system proactively ensuring accuracy. Looking beyond December 8th, your state pension will continue to be uprated every April under the triple lock system, assuming that policy continues. The percentage increase each year depends on which of the three measures of the triple lock is highest, and that varies from year to year. Here are your key takeaways from today. December 8th is when new state pension rates and calculation methods take effect in the DWP system. If your payment is processed on or after that date, you receive the new increased rate, which is £221.20 per week for the full new state pension or £169.50 per week for the basic old state pension. Some pensioners are also receiving correction payments for historical underpayment. If you think you might have been underpaid, you need to proactively contact the pension service to have your case reviewed. Check your December payment when it arrives to verify it is the correct amount. If your payment day is changing, watch for the letter explaining your new payment day. Understand how the state pension increase might affect other benefits you receive, particularly means-tested ones like pension credit. Be aware that the increase is taxable income, which might affect your tax position. Most importantly, do not assume the DWP has everything correct. Check your own entitlements, verify your payments, and challenge anything that does not seem right. You have worked your entire life and paid into this system. You deserve every penny you are entitled to, and it is worth taking the time to ensure you are receiving it. That is everything you need to know about the December 8th state pension changes. Stay informed, stay vigilant, and make sure you are getting what you are owed. This is Britain Benefits Alert, keeping you updated on everything DWP and pensions.